Okay, let's unpack this. You know how we love diving into new and complex topics, especially when they're making big waves. This week, we've got a truly fascinating deep dive for you, pulling insights from our usual suspects like investing.com, CNBC, and Yahoo Finance. We're talking about the public debut of a company that perfectly straddles the line between traditional finance and the booming digital asset world, Gemini Space Station.
Yeah, and what's truly captivating here is that Gemini's story isn't just about the ever-changing landscape of digital assets. Not at all. It's a, it's a perfect lens to see how bigger economic currents and technological shifts are pushing these new frontiers forward. Our mission today is really to sift through these sources, extract those crucial nuggets of knowledge, connect the dots, and help you understand what this all genuinely means for your world.
Right. Now let's jump into the main event. Gemini Space Station, the crypto platform many of you will recognize, just had its public debut on the Nasdaq. So tell us, who exactly is this company and who are the minds behind it?
Okay, so Gemini Space Station Ltd., or GEMI as it trades now, it was founded back in 2014, right here in New York. Their core mission has always been to build a robust crypto platform for buying, selling, and securely storing digital assets like Bitcoin and Ether. Pretty straightforward start, but they've really built out a comprehensive suite of services over the years. They operate a derivatives exchange, offer staking services.
That's where you earn rewards by locking up your crypto.
Exactly.
Yeah.
You lock it up, you get returns. They also have an over-the-counter trading desk for those large private transactions and institutional-grade custody solutions. Very important for big players. They even have their own U.S. dollar-backed stablecoin, a U.S. credit card with crypto-backed rewards, and interestingly, a Web3 studio focused on things like NFTs.
So like a creative hub for decentralized internet projects.
Precisely. They cater to everyone from individual retail users like you or me, all the way up to major institutional investors. Think hedge funds, asset managers.
Yeah.
And as you hinted, at the heart of it all are the very well-known founders, the Winklevoss brothers, Tyler and Cameron.
Ah, yes, the Winklevoss. And their journey to go public wasn't exactly a quiet affair, was it? There was a lot of buzz around the pricing alone.
Oh, far from quiet. The demand for Gemini shares was palpable. You could really feel it. And it's reflected vividly in their IPO pricing evolution. They initially targeted a price range of, I think it was $17 to $19 per share.
Okay.
But the market had other ideas. By September 10th, due to just overwhelming demand, that range was bumped up significantly to $24 to $26. And then, late on Thursday, September 11th, the IPO was finally priced even higher, at $28 per share.
Wow.
And what's truly remarkable here, the offering was over 20 times oversubscribed. 20 times. Meaning demand just completely swamped the supply of shares. They capped the proceeds at $425 million through the sale of 15.2 million shares. But that kind of oversubscription, it really tells you something about investor appetite for this type of company.
20 times oversubscribed. That's an absolutely incredible sign of market hunger. It really sets the stage. So with that kind of anticipation, how did Gemini actually perform when the bell rang on its first day?
Well, it was quite the debut. On Friday, September 12, 2025, so just yesterday,
Yeah.
GEMI shares opened for trading on the Nasdaq at $37.01.
Okay, so a big jump from the 28 IPO price.
Yeah, a very strong 32% jump right out of the gate. During the trading day, it even surged as high as $45.89, almost hit $50.
Bro.
It then settled down a bit, closing the day up 14.3% at $32. And after-hours trading showed a further gain to $33.02. To put it in perspective, before trading even began, the company already commanded a market capitalization north of $3.3 billion. One source, investing.com, actually listed it higher at $3.75 billion pre-trading.
So significant market enthusiasm, clearly. But what about the company's underlying financial health as it transitions into being a public entity? That's always the big question.
It is. It's the critical question for any investor, really. Looking at their financial metrics, Gemini reported revenue of $136.45 million.
Okay, revenue sounds decent.
It does, but
Yep.
they also posted a pretty significant net loss of $399.65 million.
Oof. Nearly $400 million in losses.
Yeah. To break that down a bit, they had a net loss of $159 million in 2024, and then another $283 million just in the first half of 2025.
So the losses are accelerating.
It appears so, based on those numbers. Now, that's a lot of red ink, right? And you ask, how do investors square these losses with the strong IPO demand and, the Winklevoss's long-term bullish outlook? It suggests that investors are clearly prioritizing market position and future growth potential over immediate profitability.
Which is pretty common in high-growth tech, but maybe riskier in crypto.
Exactly. It's a narrative we see often, but
Mm-hmm.
definitely one to watch closely in the volatile crypto space. On the positive side, though, they held over $21 billion of assets on their platform as of the end of July.
21 billion.
Billion,
Yeah.
a B, which definitely indicates substantial user engagement and, importantly, trust in the platform.
That's quite a paradox. Significant losses, but huge assets under management. And then there's that intriguing data point you mentioned from one source. 0 employees.
Yeah.
0 employees. That's genuinely surprising for a company managing over $21 billion in assets and going public. What does that imply? Is it a reporting anomaly?
It's certainly a head-scratcher, isn't it? It suggests either a very, very unique operational structure, maybe highly automated or heavily reliant on contractors, or perhaps it's just an aggregation of data that's reported differently than a traditional company. It definitely stands out and warrants further investigation if you're a potential investor. But it does hint at maybe a lean, perhaps highly automated model. And this kind of ties into the bigger strategic picture the Winklevoss brothers have been championing for years.
Exactly. It hints at a very specific approach. Which leads us to the architects themselves. The Winklevoss twins, they've been advocating for crypto for ages. Given these financial specifics, what is their long-term vision, and how does Gemini fit into that bigger picture?
Well, the Winklevoss brothers are true pioneers in this space, no doubt about it. They were among the earliest Bitcoin investors and famously the first documented Bitcoin billionaires. They've consistently championed Bitcoin as gold 2.0, arguing it's a superior store of value, and have even projected its price reaching, get this, $1 million in the next decade.
$1 million per Bitcoin. Wow.
Yeah, a bold prediction. Their efforts to bridge Bitcoin and traditional finance go way back. Remember, in 2013, they submitted the very first application for a Bitcoin ETF.
The exchange-traded fund, yeah.
Right, a fund that trades like a stock. It was unfortunately rejected by the SEC back then. Concerns about fraud, market manipulation, the usual early worries.
That rejection really set the stage for years of debate, didn't it?
It really did. But through it all, they've been consistent advocates for what they call smart regulation. They believe it's crucial to establish clear rules for this crypto financial revolution. And Gemini, for them, is clearly a foundational piece of that vision, a trusted, regulated platform designed to bring digital assets into the mainstream.
It sounds like their persistence is finally paying off with this IPO. Okay, so beyond Gemini, how's the broader crypto market reacting to all these developments? Is that optimism contagious?
The broader crypto market is definitely showing signs of an uptick, and yes, that optimism does appear to be spreading. As of around noon Eastern on Friday, September 12th, Bitcoin climbed nearly 1% to the $115,000 level.
$115,000.
Which put it up over 3% for the week. So back-to-back weekly gains for Bitcoin. Ether also saw a boost, rising nearly 3% for its first weekly gain in 3 weeks. And Solana's token, SOL, jumped over 5.5% just for the day and a significant 16.5% for the week. That's its best performance since the end of January.
So a general upward trend.
Yeah, reflects renewed optimism, perhaps a growing maturity in the market. It seems connected.
And it feels like Gemini isn't the only one testing the public market waters lately. Is this a broader trend we're seeing, more crypto companies going public?
It absolutely is a broader trend. Gemini's move isn't happening in a vacuum. It's indicative of what analysts are calling a friendlier regulatory environment for crypto IPOs. We've seen other significant players making their public market debuts just recently. For example, Figure, which is a blockchain lending company, also had its public market debut this week.
Okay.
Stablecoin issuer Circle has also been making headlines with its IPO plans, as has Bullish, which is a crypto exchange backed by Peter Thiel.
Right, bullish. So quite a few players moving in this direction.
Exactly. This wave of public listings suggests a growing maturation and, dare I say, maybe an increased acceptance of the crypto industry within traditional financial markets.
And it's not just about these crypto native companies going public. We're also seeing traditional finance, TradFi, embracing digital assets in a big way. The lines are really starting to blur, aren't they?
You've hit on a crucial point there. The convergence is accelerating rapidly. Take Tether, for instance. They issue USDT, the largest stablecoin. They're making a very strategic move by launching a new token, UST, specifically designed for U.S. institutions, and it's intended to be regulated under something called the Genius Act.
USA, distinct from USDT. Interesting.
Very distinct.
Yeah.
And to kind of cement this push for a firmer footing in the U.S., especially after years of regulatory scrutiny, they've hired Bo Hines.
Bo Hines, wasn't he?
Yeah, formerly the head of the White House's crypto advisory group, he's now CEO of Tether's U.S. business, which will be headquartered down in Charlotte. That's a clear signal of intent, a very strong signal.
Hiring someone from the White House's crypto advisory group is definitely a strong signal. And we're seeing some major partnerships, too, suggesting this isn't just about crypto companies anymore, is it?
Exactly. And a very notable collaboration just unfolded between the investment giant Franklin Templeton and the global crypto exchange Binance.
Franklin Templeton and Binance, that's a big one.
Huge. They're teaming up to develop digital asset products. Their goal, they say, is ambitious: to take tokenization from concept to practice for clients. Basically, achieve efficiencies in settlement, collateral management, portfolio construction, all at scale using tokens. They firmly believe blockchain tech will underpin future capital markets, and they want to meet clients in these digital wallet ecosystems, Web 3.0. And they specifically mentioned Binance's hundreds and hundreds of millions of users.
Tapping into that massive user base.
Precisely. And this isn't isolated. We've seen Coinbase and JP Morgan partner up to offer bank customers ways into digital assets. Anchorage Digital provides crypto custody for BlackRock's clients, both retail and institutional. And remember, the removal of that SAP 121 restriction back in January,
Ah, yes, the accounting rule.
that accounting guidance that made it tough for banks to hold crypto. Removing that really unleashed a whole bunch of TradFi legacy firms to engage more deeply with this technology.
So it sounds like this isn't just hype or speculation anymore. There's real innovation in how these assets are being integrated and used in practical financial applications.
Precisely. We're seeing practical applications emerging that are fundamentally altering, well, trade economics. For instance, Franklin Templeton, Standard Chartered, and the exchange OKX launched a pilot trading platform. This allows institutional clients to use crypto and tokenize money market funds.
Like their Benji fund, the one with the yield.
Exactly, like Benji, offering that 4% plus yield. They can use these as collateral in off-exchange transactions. Think about sophisticated investors, like crypto-native hedge funds. They can now use yield-bearing investments as collateral, which helps improve the metrics of their complex trading strategies. It's a potential game changer for capital efficiency.
That's a fantastic example of real-world utility.
Yeah.
Okay, but let's pull back even further now. These crypto and tech stories, they're unfolding within a dynamic global economic landscape. What's the bigger picture looking like for the traditional markets?
Well, the broader market signals are overwhelmingly positive right now. Global stocks recently hit record highs. The Dow Jones closed above 46,000 for the first time ever.
46,000 on the Dow.
And the Nasdaq closed above 22,000, also for the first time. And this upbeat mood wasn't just confined to the U.S. Japan's Nikkei and Europe's FTSE 100 also hit fresh record highs. It's a truly global rally we're seeing.
So what's driving this remarkably upbeat mood across the world? What's the main engine here?
The primary driver, most analysts agree, is that rate cut expectations are on the rise.
Ah, the Fed.
The Fed, yes. We've seen jobless claims in the U.S. rise to nearly their highest in 4 years, which signals some softening in the labor market. And even though the CPI, the Consumer Price Index, trickled up slightly last month, it hasn't stopped the bets on the Fed finally easing policy, maybe as soon as next week.
Even with inflation still a bit sticky.
Yeah, even with that sticky inflation. For example, food prices were up 0.5% month over month, and core service prices, which had been heading lower, kind of stalled. But the Federal Reserve operates under that dual mandate, right? They focus heavily on both price stability and maintaining full employment. So the employment dynamics, those rising jobless claims, they're a strong factor pushing towards a cut. And crucially, inflation signals from the University of Michigan Sentiment Survey have dissipated, which is a key indicator the Fed watches closely.
Got it. And what about the dollar? How's it faring in this environment of rising rate cut expectations? Down, I assume.
The dollar is still very much set fair for further weakness. That seems to be the consensus. The U.S. administration, many believe, is probably quite happy for a cheaper dollar.
Why is that?
Well, strategically, it helps U.S. exports by making them more competitive globally. And it makes imports more expensive, which can potentially help domestic industries. Experts anticipate that the U.S. growth exceptionalism, that period where the U.S. economy was strongly outperforming others, will likely dissipate, leading to further dollar depreciation into 2026. And this sentiment is also driving increased investor hedging of U.S. dollar exposure, People are looking to protect against its potential decline.
Okay, and for our listeners, what does all this talk of Fed rate cuts actually mean for their money, especially things like mortgages and car loans? It seems like a lot of people just assume Fed cuts equal lower mortgage payments.
Yeah, and this is a really crucial insight for you to consider. While it feels intuitive, right?
Yeah.
Fed cuts should mean lower borrowing costs. The reality for long-term loans like mortgages, auto loans, student loans, it's more nuanced. These typically track the yield on U.S. government 10-year Treasury debt, often just called the 10-year yield. Here's the catch. Fed rate cuts do not guarantee lower long rates. History shows this. Long-term rates did go lower in 8 out of the 10 Fed cutting cycles since 1975, which is what you'd sort of expect. But crucially, this didn't happen in 1995, nor did it happen in the most recent cutting cycle. In that last cycle, the 10-year yield actually surged over 100 basis points. That's a full percentage point, leading to much higher mortgage costs despite the Fed cutting its short-term rate.
That's a really important distinction. So why the disconnect? Why wouldn't a Fed cut automatically translate to lower mortgage rates? What's going on there?
There are a few key reasons. First, it's basic supply and demand. Simply put, Uncle Sam is borrowing more money than ever. Massive deficits mean a higher supply of Treasury bonds hitting the market, which can push yields up even if the Fed is cutting short-term rates.
Okay, supply of bonds. What else?
Second, there's something called the term premium. This essentially accounts for uncertainty over the long term. Things like creeping inflation, potential tariffs, rising energy costs, all these things make investors demand higher compensation, a higher yield for tying up their money for 10 years or more. And third, global yields are surging around the world. It's not just a U.S. issue. Higher rates elsewhere can pull U.S. rates up too, as capital seeks the best return.
Right, it's a global market.
Exactly. So the bottom line for you is this. Do not assume Fed cuts will automatically drop your mortgage. The long end of the yield curve listens to deficits, uncertainty, inflation expectations, and global capital flows.
So much more than just the Fed's next move.
Precisely. You need to watch the broader bond market, Treasury auctions, foreign demand, news on tariffs, not just the Fed announcement.
That's really clear and definitely actionable advice for our listeners. Speaking of tariffs, that's another big economic story this week, adding to that global uncertainty you just mentioned.
It certainly is. The U.S. Treasury reported that revenue from tariffs neared $30 billion in August alone, and July was actually a record month at $27.7 billion.
$30 billion in 1 month from tariffs.
Yeah. Significant sums. This data comes just as Mexico decided to raise tariffs on cars imported from China and other Asian countries to a hefty 50%.
50%, that's a huge jump.
It is, and this move is widely seen by many observers as a strategic play, perhaps to win favor with President Trump, given his past emphasis on trade protectionism and renegotiating trade deals. Adds another layer of complexity to global trade.
Definitely. Okay, shifting gears slightly but staying with market movers. Beyond finance, we're seeing other major tech players making significant moves, which also tell us a lot about where the market is headed. Artificial intelligence, AI in particular, seems to be driving a huge amount of innovation and investment.
Absolutely. AI is everywhere. Take the non-binding deal between Microsoft and OpenAI. This allows OpenAI to restructure itself into a for-profit company, seek to raise capital, and potentially go public down the line.
Right, moving away from the nonprofit structure.
Exactly. Microsoft initially invested, what, $11 billion? And had exclusive rights to sell OpenAI software through its Azure cloud platform. Under the current terms being discussed, OpenAI's original nonprofit arm is expected to receive over $100 billion.
$100 billion.
Based on its roughly $500 billion private market valuation. About 20%. It just shows the immense value being placed on cutting-edge AI. And we're also seeing a booming AI hardware market. SK Hynix, which is a main supplier to NVIDIA, announced they're ready for mass production of their next-generation HBM4 chips. These are absolutely crucial for the high-performance computing that AI requires.
So the infrastructure build-out is accelerating.
Massively. And Micron's stock also closed up significantly yesterday, partly due to analyst upgrades, all indicating this skyrocketing demand for the underlying AI infrastructure, the chips, the memory, everything.
And it's not just the new AI-focused giants. An old tech giant seems to be reinventing itself in this new landscape, isn't it? Oracle looks like it's having quite the renaissance.
You're talking about Oracle, and yes, they really are. They just reported an amazing quarter, according to analysts, with a ginormous upside surprise, particularly in a metric called remaining performance obligations.
RPO, yeah. That shows future contracted revenue.
Exactly. It's a key indicator of future business. Oracle has truly evolved from being primarily a licensed software company, databases and such, to a dominant cloud business. They encompass both software as a service, SaaS, and infrastructure as a service, IaaS. Their IaaS revenues hit $3.3 billion, and SaaS revenues hit $3.8 billion in the quarter.
So they're competing head-on with AWS, Azure, Google Cloud now.
They are. They're aggressively building out data centers using a modular approach, which apparently helps them scale quickly. It positions them as a serious contender against those giants in the cloud infrastructure space. It's quite a testament to their adaptability. And just for context, Adobe also posted better than expected Q3 results. Revenue up 11% year over year. They're touting their successful AI push despite, heated competition in the creative software market. AI is boosting them too.
It seems AI is the tide lifting many boats right now. Okay, any other quick market movers before we wrap?
Briefly, yeah. There's talk of Paramount Skydance preparing a bid for Warner Brothers Discovery, which could create a massive streaming giant, but would definitely face antitrust scrutiny.
Another huge media consolidation, potentially.
Potentially.
Yeah.
And Tesla shares were up, reportedly on growing optimism about robo-taxis, that recurring theme, and also just benefiting from the general hopes of Fed rate cuts lifting growth stocks.
Wow, okay. From crypto debuts like Gemini to major Fed decisions potentially next week and all these AI advancements, it's abundantly clear that the financial and tech worlds are more interconnected and, well, dynamic than ever before.
Indeed. It's really something to watch. As we see a crypto exchange like Gemini successfully enter the public markets and simultaneously see traditional finance giants embracing digital assets all alongside these massive shifts in AI and cloud computing, it really raises an important question for you to consider. Are we truly on the cusp of an entirely new era of market dynamics, an era where innovation dictates value in ways we're only just beginning to understand? Definitely something to mull over as you navigate your own financial landscape.